Hi guys. As an extension to the financial planning podcast we had a couple of weeks ago, we have Mr. Balaji Rao again with us, and it's something very specific within the financial planning world that we wanted to sort of touch upon for our viewers, which is mutual funds. We've heard a lot about it, sir. Mutual funds, what they can do, what they can't do. And when I think mutual funds, personally, I always remember this disclaimer that I hear on television. Mutual fund investments are subject to market risk. Right there, I still feel in India, people are still skeptical about mutual funds. Although mutual funds are supposed to be less riskier than investing directly in the capital markets. But can we clear that myth to start off with? Mutual funds versus a fixed deposit. Can we even compare the two or not?
No, it's true that when you say that, people remember the negative aspect of mutual funds by remembering mutual funds subject to market risk. Read scheme documents carefully before investing. It's very tragic for such a wonderful asset class with such ease of transaction facilitated. So people remember mutual funds not as an investment product, but as something which is risky by nature.
Right.
I think again, if you ask me a question whether you can compare mutual funds with fixed deposit, I think these are apples and oranges. I'm investing in fixed deposit for a different purpose. I'm investing in any other asset class for a different purpose.
Right.
In any investment you do, end of the day you're attaining returns only. So, if you want to generate returns that are double digit, and that is what you have to do now. It's like when you're driving on a highway, it is your duty to drive at a permissible speed of 100 kilometers per hour.
Right.
On that road also, if you are driving at 40 kilometers per hour, does it make sense?
Right.
That means the market opportunities are there for you to grab.
Correct.
What is market opportunity? Fixed deposits, post office savings, gold, mutual funds, stocks, real estate. All these are opportunities that comes your way.
Correct.
During your journey of investing that spans maybe about 30 years of your active earning life.
Right.
So in these 30 years, if you continue to think with ignorance that mutual funds subject to market risk, so don't you think you're missing out on a great opportunity that these funds or mutual funds, there are selective funds which I can quote when the appropriate time, because this is not a forum to promote any particular mutual fund scheme as such.
Right.
But there are several schemes that has created some immense wealth. Okay, so we are just stuck to the traditional opportunities such as FD and post office savings,
Right.
where we are not trying to explore at all.
Correct.
So that is where I think there's a big disconnect.
And also, like we were talking a little while earlier, we were talking about, our post office savings and fixed deposits. Now, relative to inflation rates, we really can't, that doesn't really factor that in, does it? Like over a period of 15 years, something like a fixed deposit doesn't really factor that in. So we say, for instance, have an objective of a corpus of 3 crores in 15 years. Now, a fixed deposit may not necessarily help us achieve that with any surety, given the rates are subject to fluctuation, the bank interest rates. But something like a mutual fund, I remember in one of our conversations, you had told me about the compounding effect of a mutual fund. Can you just share your thoughts on that in terms of macro factors being factored in over a period of 15 years on a bank deposit instrument versus a mutual fund?
See, first of all, fixed deposits were not designed to create wealth. Okay, fixed deposits and post office savings were always to preserve your wealth, where your capital is protected.
Correct.
And you generate income over it. Your capital never grows.
Correct.
Neither in fixed deposit nor in post office savings.
Correct.
You can't invest in fixed deposit and become rich. Once you become rich, then you can put money in fixed deposit. There's a reality of these asset classes.
Right.
Okay.
Right.
Now, why should you choose mutual funds? Is that that alpha is generating higher return compared to a particular benchmark.
Correct.
Okay. So what is it you are trying to achieve out of your money that you work and earn hard? You have to put your money also to work hard, no?
Of course, money should work
Now,
for you.
let us take an example of PPF. The maximum permissible amount that an individual can invest in a year is only 1.5 lakhs. That is
According to the
12,500 rupees.
tax bracket,
As per section 80C,
right.
they can invest on 12,500 rupees.
Correct.
That means if you invest 12,500 rupees per month for 15 years, and it generates 8% as per the current rate of return, assuming this rate remains to be the same, which will not remain to be the same.
Correct.
Because interest rates on PPF are set every 3 months now.
Oh, is it? Is it every quarter?
In the falling interest rate scenario,
Right.
these interest rates are going to go down.
Of course.
Okay, so even if you will generate about 6% as your average return in the next 15 years, your 12,500 rupees per month can generate approximately 40 lakh rupees in 15 years.
Wow. Okay.
Now, if you start investing at 30 years,
Yep.
you invest 15 years, 40 lakhs you generated.
Correct.
You start again at 46th year, continue 15 more years, one more 40 lakh rupees you generate. Now, how much did you generate? You generated 80 lakh rupees in your 30 years of investing. Okay?
Right.
Now, at the end of 60th year or as per the retirement age, is 80 lakhs enough for you to take care of your retirement life or post-retirement life?
Of course not.
That means for the same event, you are investing more amount and achieving less corpus.
Correct.
So had you diverted at 12,500 rupees per month, doing a good asset allocation and trying to allocate at least 50-60% of that money into a mutual fund that has historically generated return, which is 10% and above, which is proved, measurable, with all evidence.
Right.
That is more than 10%.
Correct.
If you invested for 10 years and above, then why people are still sticking to the same old fixed deposit? You know the tenures are fixed.
Correct.
You know the returns are fixed.
Correct. Correct.
You know it can't generate generate returns which is beyond 10%. I mean the single digit. So what are people trying to understand? So mutual funds were introduced for common investors to take that opportunity in both the hands.
Right.
And then allocate. Nobody's telling you invest all the money in mutual funds.
Correct. That's a good point. Correct.
Okay, you have to do asset allocation. So what do you say in mutual funds? Younger the age, you invest more. So as you start aging, your life will tell you that my risk will go down.
Correct.
I will reduce my allocation into
Correct.
mutual fund or equity mutual fund per se.
Correct.
So that's where you structure yourself is what.
Makes sense. So now, supposing, say, assuming I'm the person now, I'm convinced of what you've told me. So I've broken that bubble, that bad perception, and I want to get into the actual asset allocation and investing in mutual funds. Now, how do I go about it? Is the process one simple? Is there a minimum amount that needs to be put in? And really, how long should I know you mentioned it should be 10 plus years, but are there options where I can do a short-term versus long-term versus medium-term investment in mutual funds depending on my requirement?
See, mutual funds are such a wonderful product. I'm telling without any biasism. Just because I am part of the industry doesn't mean that I have to be biased about mutual funds. You know, mutual funds can be invested for even one day. It starts with 1 day of your surplus money.
Right.
You can go on to invest for any number of years.
Right.
There's no restriction that you have to do only for these many days, months, years.
Sure.
Unlike other traditional products.
Sure.
Okay. Now, one is when people are investing, they should first have discipline and faith. Okay. Now, what happens, just like your tomato price, onion prices fluctuate. Even your petrol bunk, if you go today, today's price does not be the same tomorrow.
Correct.
Tomorrow's price is not day after tomorrow. That price fluctuates, isn't
Correct.
it? Like that, equity market also fluctuates.
Absolutely.
So after you invest, if the NAV has gone down, if you do not panic, if you think that what falls will go up, what goes up will fall, what falls again will go up. That is a fund of life.
Correct.
That is the fund of mutual funds also.
Correct.
So if you are able to follow that philosophy, that I am going to stick to my goal of staying, that's why I said 10 years, no. Mutual funds have been segregated into debt, where you can invest for shorter duration,
Right.
where you don't expose your capital into risk,
Correct.
and want to take care of your 1 day to probably 5 years of your life events. Don't put in equity, no. So beyond 5 years, you have hybrid funds, which is a mix of equity and debt.
Correct.
They are pure equity,
Correct.
or index funds, aggressive hybrid funds, large cap funds, multi cap funds, mid cap funds, small cap funds,
Right.
thematic sector. It is
Right.
designed to give equal opportunities.
Exposure also, right.
It is giving equal opportunities to every type of investor. Here, the type I'm trying to say is about risk.
Correct.
I'm a low risk taker, just like eating pani puri, masala puri, no. The guy will ask you, you want more spicy, less spicy, moderate spicy. He will make and give you, no.
Correct.
Mutual fund design these kind of things already. So what is the confusion?
Correct. Correct.
So if you understand mutual funds as a solution and not
That's
as a
good point.
product,
That's a good point.
okay, that is where I think the learning and also the possibility of getting returns out of it
Right.
will be obtained by investors. And what is the minimum investment?
Right.
You have to just put 500 rupees per month.
Irrespective of which.
Irrespective of, see, mutual funds are not having any discrimination of gender. A male can invest, a female can invest. There is no age limit. Even today, a child is born, the parents can create an account if you get a PAN number.
Right. Right.
Okay, you can start. Baby also will grow. Investment also will grow. Okay,
Sure.
you can. You're old, you can invest. You're young, you can invest.
Right.
Your pocket money, you can invest.
Right.
So all you need to have is a PAN card, address proof.
Right.
What else you need?
And what about the processes? So that's great to hear that, irrespective of age, you're a child, an 80-year-old person, mutual funds, I think, it sounds like it's a one-stop solution for all, in a way.
Yeah.
But is there what about the ease of the process?
See, when you go to a bank, you have to open a bank account.
Correct.
Do you think it is cumbersome?
I used to, but not anymore. Today,
No.
I don't think it's...
See, when I say cumbersome, see, you need to be established as an individual, no? So who are you? Sanjay, who are you? You know you are Sanjay.
Correct.
But the banker is meeting you for the first time.
Correct.
The banker has to establish
You're
your
talking about KYC.
identity. Correct, no? So a mutual fund company also needs identity. But where did you get your money from?
Fair.
Who are you? Are you an Indian?
Fair.
Are you from other country?
Right.
Okay.
Correct.
So what has government done? The identity. What is that? First PAN number is an identity. Right? Your address proof, maybe Aadhaar card, passport, driver license, voter's ID.
Right.
We'll give you 2 copies of this.
Sure.
Fill a form,
Sure.
submit. In 24 hours, your KYC is ready. This is a one-time process. Remember, if you have to open multiple bank accounts, you have to do KYC multiple times in every bank.
Right. Correct.
Mutual funds are not like that. This is a one-time process.
Okay.
If you submit, you can download a form on internet.
Fantastic. Okay.
Fill that form, put a photograph, passport's a photograph, enclose a PAN card, enclose an address proof, sign, submit. One-time effort.
Right. Understood.
Wherever, whenever, you can be in Kashmir, Kanyakumari, be in Surat,
Right.
you can be in Calcutta, anywhere you can invest.
Fantastic.
So the process is very simple. The only thing people have to think, investing is something which is simple and easy. That is where I think
Understood.
this entire concept of mutual funds, which remains to be misunderstood, it is a wonderful long-term opportunity to invest.
Fantastic.
Okay, you should stay
invested.
invested,
disciplined.
go through that market troughs.
Right. Correct.
But that is where you are going to create wealth. Even real estate, for example, sometimes your locality where you purchase, the rate should have been down for some time.
Absolutely.
Don't you wait for that to recover and to create that wealth?
Absolutely.
So why you don't have the same understanding and patience is what I try to reason it out.
Fair. Okay. Fantastic. I mean, I hope this podcast, and I think it's very dear to me, also has helped really bust a couple of these myths that are out there around mutual funds. It's a fantastic product that is solution oriented. Like Sir said, I think it's more of a solution than a product. So I would definitely encourage everybody to really think about it, and any doubts, clarifications, do let us know. Circle back to us, and we're more than happy to sort of address any questions. So thank you so much for the time. Thank you, sir, again.
Thank you so
and
much.
Look forward to having another conversation.
Thank
together.
you.
Thanks.